All right, guys, that's all I got from the news on a pretty light day, actually. Let's move right into our last segment here in Jedi Options. And Tyler, I'm excited for this one for a couple of different reasons. Number one, I love the company you're going to highlight. It is on the Tackle 25 fundamentally strong list of stocks that you can do cover calls on that our pro members use all the time for their watch list for cover call trading and naked put trading, as well as an industry that I think is picking up here recently in the solar industry. So, what you got today here for Jedi Options, Tyler?
Yeah, so we highlighted, I'll cut to the chase here. So Canadian Solar was on the options report this past week. And if you back it up a step though, and you say, okay, so what's going on with solar? Like what do I need to know about the solar industry from a trading perspective? You know, a couple of things. Number one, it's a growth play, right? Solar stocks are part of the growth complex. When investors are putting money into more let's say more aggressive stocks, stocks that have higher volatility, stocks that have more growth potential, stocks that maybe don't have as good fundamentals right now, but they got good prospects for the future. Solar kind of plays in that sandbox. And so the backdrop you want to have favorable price action, and I think a good story, a good theme for solar, is growth stocks leading, which we have been talking about all day today. The NASDAQ being at all-time highs helps this. Chip stocks making a comeback helps this. And just a general bullish sentiment in the marketplace helps solar. These guys also remember the Democrats sweeping Congress, taking the presidency, right? Democrats generally are viewed as pro, what's the word I'm thinking of? Solar power, right?
Yep.
Pro
Alternative energy,
alternative energy. There we
initiatives,
go.
stuff like that. Mhm.
Yeah. So they, so you've also got that kind of tailwind on the back of this. But as is often the case, Wall Street gets a little bit giddy, too far out over their skis, and they're like, all right, well, let's take Canadian from $10 to 65. And when you get that type of growth and particularly like post November, after the presidential election, it goes from 40 to 65. When you see valuations get that stretched, when your multiples are that high, you are subject to some rude awakenings when reality doesn't prove as as optimistic and as good as was priced in. So you got a comeuppance in Canadian Solar. Went from 67 back down to 35, basically a 50% haircut, Tim. And I suspect, if you had ridden the wave up, you probably weren't very happy about that. But the question for those that aren't in it is, when do I get interested? And the answer is when the trend starts to show stability, when we start to see bottoming patterns emerge. And ultimately, look, this is messy, not much going on here until recently. We really hadn't mentioned solar at all, I think, on the bullish scouting reports for obvious reasons, until finally, as is often the case, sellers wash out. You get some subtle changes in character, it stabilizes, and this is essentially what it looks like coming into this week. And now you can map out a bullish trade. You can map out, hey, I got a little ascending triangle here, maybe a little sideways trading range, if you will, popped above the 50-day moving average on Friday with above average volume, right? Raises an eyebrow, you perk up, you say, okay, this is percolating, things are going on here, let's pay attention. That's what got it on the report this week. And the thing is, you don't know what's going to happen, but you put yourself in enough spots, enough good spots where usually every once in a while you get paid. Here's a situation where Canadian Solar's like, look, let's do this. And you got a massive pop. And it's just a delight when the chart does what you would expect it to do, when it rewards you for finding a nice little bottoming pattern. You nailed it the day before the breakout. It's always good when you wake up on Monday, Tim, and you look like a genius because the stock that was on the report's up 10%. So, that's the technical analysis. You've got a bottom. The daily chart is now above all major moving averages. I find this interesting. And the question you ask yourself is, do you think that was one and done? Do you think that was it? They loved solar for a couple of bars and it's going to crumble and go right back into a downtrend. Could happen. Or do you think this reversal was legit? and that the sentiment has changed enough where there is more to come. If that is the premise, if that's what you believe, then you are interested in secondary patterns. You are interested in the next setup because you really didn't want to chase this yesterday anyways because it had gone up too far too fast. So what interests me is this little pullback here. I don't know if it's going to be a 1-bar pullback or a 2-bar pullback or a 3-bar pullback. All I know is this breakout was legit. Institutions were piling in. I think it is a breakout that sticks, which means I'm a buyer of the next dip. And I want to get prepped for it today in the event that it doesn't pull back any further, right? Because if I don't, and I say, oh, it's got to pull back 4 days or something, and then it rips tomorrow, I miss it again. So you got to be anticipatory here in terms of mapping out trades. So that's the setup. I'm now going to go through comparing 2 different option trades, but any comments on the setup, Tim?
No. In fact, I appreciate that you ran through that. Obviously, we had this on the option report over the weekend, and it did end up following through. We don't expect that kind of price movement, obviously, on a Monday. We were just anticipating the breakout. Now it's carried through. So it's kind of left us in a position. So now how do I trade it, right? Which is why I think it's a perfect candidate for Jedi options today, because it may not be the best just straight delta trade after the rip. There might be some other, more creative ways to play it. So I'm really just interested to see how you're going to draw those two things up.
Yeah. So what I'm going to compare with these 2 option trades is going to give you a choice of, do you want, and this is often the choice, right? This is often the choice that you have with building an option strategy. A, do you want a high probability cash flow play that's going to pay out as long as this doesn't completely implode? Or B, do you want to do the type of trade where if you get another Monday and the thing rips 10%, you're really going to have a rich reward, right? And so you take your pick. And in choosing these 2, I think they're both good options. Otherwise, I wouldn't present them. So I don't have a super strong opinion. In a situation like this, one thing that helps me make the choice is, what do I already have in my portfolio, right? And we'll talk more about that here in just a minute. But let's go. Trade number 1 is a bull put spread, $45 stock. Now you say, well, how's the volatility? Are the options expensive? Are they cheap? Well, the thing about Canadian Solar is the implied volatility, the actual volatility that's priced into options is quite a bit on balance, because Canadian Solar is a volatile stock. So in general, month to month to month, there's always premium available in the options. This is not AT&T. This is not Verizon. There's always premium available. So even though you could argue that we're in the lower quartile of the 1-year range, the rank is not particularly high. It doesn't matter. There's still plenty of premium in the options. So I was looking at how far out of the money can I go and sell a bull put spread or a naked put and get a decent premium. And looking at the chart, well, I'd certainly like to be below the breakout area, because that way, if it comes back and retests 41, I don't get shaken out and give that the chance to become support. But quite honestly, I'd also like to be below the low of the base that preceded the breakout, because you'd really have to crumble to then get knocked out if you use your strike price as your stop loss. So something around 38, 37 or below would be nice. So I go to the trade tab. I don't have enough time in July. I prefer not to use the weeklies if I can avoid it because of liquidity. I think 51 days is perfectly fine. So I'm going to go to August, and I'm just going to kind of go right towards those strikes I was looking at based on the chart. I'm going to go with 37. This has a 15 delta, which gives me an 85% probability of profit. There's the high probability I referenced. I'm going to sell that. And I'm going to go ahead and do a credit spread just to make it limited risk. I like to do maybe a $5 wide. So I sold the 37 put. I'm going to buy the 32 to protect myself. And that gives me about 57 cents credit. To make the math easy, I'm just going to make it 60 and assume I can get filled at that. But I need at least 50 cents. 57 is plenty, 60 is fine. So I can get a good enough return. Good enough meaning you're making 60 bucks on 410, which is, well, I can't do that in my head. Actually, hang on. It would not. Why is it 410? It should not be 410. It should be 440. I don't know why that BP is there. It should be 440. It's 60 bucks on 440. You're making over a 13% return. And if I look at the chart, I mean, here's how I would size it up. I would say, look, Do you think Canadian Solar stays above 37? You do. If you believe the breakout, this should not be below 37 in a month. Are you willing to make the bet that it stays above 37 in exchange for a 13.5% return, with a 15 delta, which, knowing what I now know about Royd, I know selling a 15 delta credit spread and getting a 13, almost 14% return translates into a good enough Royd, unless I'm mistaken. So that's trade number one. Any feedback on that one?
Well, I like a couple of the components here. If you go back to the option chain and how you had that built, going with the put side of it and building that credit out through the August. As I'm looking at the numbers here, the Royd would probably be in line with what I need, right? So I'm comfortable with that. The timeline on that trade, 51 days, is still in the wheelhouse of getting a theta trade to actually benefit from that time decay curve in a very positive way. So I think it's just properly built. There's nothing wrong with this one at all. I like it. So it's going to be interesting to cross compare it against your second choice, because you can always just go chalk here and play that vertical. Yeah.
Yeah. And as far as the timing goes, honestly, I find today a little bit of a tricky candle to try to have a strong opinion on the timing. I mean, I would not mind this coming down another day or two. You don't want a deeper retracement. Like, I probably don't want this to come down lower than maybe halfway, the halfway point for this big breakout bar. But I don't know, maybe it does come down another day. It's just tough because it's kind of a doji, right? So I'm a little ambivalent on the optimal timing as to when to pull the trigger. But see, here's the kicker. If I pulled the trigger today, Tim, I feel like I have a wide enough range. Like, I'm far enough out of the money to where I wouldn't be too concerned if I jumped the gun anyways, if it did pull back another bar or two. But so the logical then comparison or alternative would be something more directional, right? Something that gives you a little more juice if this thing pops. And I don't know that I need to be overly clever with this. Buying calls is a little bit tough for me, Tim, because the implied vol at 64%. I mean, calls are pretty pricey. And so I can get a really good spread going just by buying the 45 strike call and then selling the 50 against it. Kind of shooting for 50 as your upside target, which I think is completely doable, given that that's major resistance up there. So I also think that 51 days provides me ample time. I don't know that I really want to jump to September or October, because I think you're going to get resolution in the next couple of weeks anyways, one way or the other. And so I don't want all the extra time to make the trade take too long. So I'm going to stick with August. Just, again, this is, to me, a simple structure here. This is a bull call spread, bull call vertical, buying the AUG 45, about a 57 delta. And then again, I'm just going to stick with a $5 wide spread. I'm going to sell the AUG 50. And check this out, Tim. I don't know that you would have guessed that this was only going to be $1.85 for a $5 spread. That is quite cheap. It's quite cheap. I'm risking a $1.85 to make $3.15. So that's a lot. It's a potential 170% return. Right, like, take that, you 13.6% potential return on the put spread, like not even close. So you definitely have some explosive potential profit. The net delta 56 minus 39. I mean, you're close to, you're almost around a 20 net delta. Good enough. It's just a cheap trade, man. It's a cheap upside bet. You take a look at the risk graph. Risking a little to make a lot. And you're not asking for much. I mean, if it gets to 50 pretty quick, you made about a 50% return, then you're just waiting for time decay to make the rest of it.
Interesting couple of choices here. Let me think through this a little bit here, Ty. So the bull put, my credit was 60, right?
Yes.
50 days, I don't have an earnings in that cycle. I don't believe, at least, the earnings would be right at the back end of the August expiration, if anywhere. But it would be most of the 50 days. I wouldn't have to worry about that. I'm down below some major levels, so it would have to violate the breakout zone to come back and violate my trade. To go in the money and force me to exit and take a loss, it would have to violate the moving averages, a lot of that kind of thing. I have to see a pretty good sell-off on a trend that's now developing. So I like this side of it from a directional perspective in general, because I love breakouts. But when you're a little bit stretched here, I might take the cushion there. The advantage, obviously, on the bull call is you've got the reward to risk that's going to line up in your favor. The only hesitation I have on the bull call is just the fact that we only have the 51 days, and I'm going to be working negative time decay on that during some of the cycle there because of, quite frankly, I'm long the option at 45. That has a higher theta rate than the short option at 50 is going to offset for me. So, in my opinion, out of the two different scenarios and the way to play it, I would lean on the bull put side of it because I really like the cushion here. I like the fact that if I'm wrong, it has to break below a lot of different areas that could play defense for me. Old breakout channel at 41, old support level as well, moving averages, and it'd have to break character in the current move that it's in, which has had a nice volume spike to drive it higher. So for me here, I would lean bull put out of the two different choices. You might be able to get me on a bull call if the technical setup felt like a better entry point today, right?
Yep.
But I'm leaning bull put. That's where I would probably side on the discussion. What about you?
And I think that I'm with you. The bull call, I think, would be an easier play if, let's say, you get one more red bar or two more red bars, small red bars, then you get a nice little trigger. Because then you could maybe, instead of doing 45, 50, maybe you're doing like 43, 48 bull call or something. So yes, I think that I agree with you. I would take the bull put. And it's arguably because we might need just a touch more time, a more candle or two for the bull call to really be a cleaner entry. Just because you don't want to throw the bull call on right now and then have to sit through a 3-bar drop. It's just too much drama. So a little bit, I think if you have more confidence on the timing, it's easier to pull the trigger on the directional trade versus the theta play. So I would go with the bull put here as well.
Maddie, welcome back, first of all.
Thank you.
Yeah. We're talking bull put versus bull call on CSIQ. Tyler mapped them out beautifully, and a couple of interesting ideas. I wouldn't fault somebody for going with the delta play here, but I would kind of leaned on the theta play myself. I know that this is one of your favorite companies in this space and a good, fundamentally sound company. What's your instinct?
Yeah, great company. Yeah, I had an internet spike and had to reset the computer, so I caught the very first of, hey, let's talk CSIQ. And then I got back with, hey, but I like this. And so I missed everything besides the first word and the last word, but I'll just approach it. So I don't know the parameters you guys were dealing with, the delta you were selling, all of those are within the parameters of a good trade. Number one, we're talking about CSIQ, and it's a good cash flow stock in general. I look at this very similar to what you guys were talking about at the very end of it from a technical perspective. And I caught some of Tyler's, if I had two more bars down, maybe the bull call at that point. And I agree with that. You like the volume, you like the price movement, you like the reclaiming of moving averages, you like a lot about the directional nature of CSIQ. What you don't like is the immediate zone of support it is in regarding that pullback. You certainly could see some consolidation where the 200-day moving average is. You certainly could see a little bit of a bigger pullback here. And because of those two things, you could see some consolidation as it fights for defense after a really aggressive move that it just made, or maybe give me a little bit of a deeper pullback so we can reset that real good move it just made. In either case, if you're looking to do something immediate, you're in wait and see mode on that bull call spread, in my opinion. You're in the zone based on the fact that you just broke out, you reclaimed the moving averages, you got a good price movement, you got volume to support it. CSIQ solar in general is tied loosely to the innovation that drives the ARC index in general. But you also have some growth here as well that it's tied to. And so you got to like the zone. You just don't like that support that right now. And you don't like the trigger right now. And because of that, I do fade to I fade the bull call. I gravitate towards the bull put spread here.